Welcome back. Picture a completely average day at one of the most vital geographic choke points on the entire planet. If you were to stand and just watch the horizon at the Strait of Hormuz on any normal afternoon, you'd see this massive, almost unending parade of maritime traffic.
Right.
We're talking about roughly 120 massive commercial ships passing through those waters every single day, just laden with a huge percentage of the world's energy and consumer goods.
Yeah, it's essentially the main artery of global trade.
Exactly. But fast forward to March 3rd, 2026. On that specific day, if you looked out at that exact same horizon, you wouldn't see 120 ships. You wouldn't see 50. You wouldn't even see 10. For that entire 24-hour period, exactly one ship passed through. Just one.
Which is an absolutely staggering draw cost.
It really is. Welcome to the Deep Dive. We are thrilled to have you with us today. If you hate information overload but love getting straight to the mechanics of massive world-shifting events, this is the perfect mystery to unravel.
It's a fascinating situation to look at.
We're looking at an incredibly detailed maritime update. It was compiled by a former merchant mariner turned academic, someone who actually sailed these massive vessels before moving ashore to study maritime policy. The mission of this deep dive today is twofold. First, to unpack the invisible forces that functionally shut down one of the world's most critical waterways overnight.
Right.
And second, to explain exactly how this geopolitical paralysis is going to directly impact your wallet.
Well, before we get into the mechanics of the shutdown, there is a crucial misconception that we need to clear up right away.
Oh yeah, the blockade assumption.
Exactly. When people hear that traffic through the Strait of Hormuz dropped from 120 ships a day down to a single vessel, the immediate assumption is that a government stepped in and threw up a military blockade.
That Iran just closed the door to the strait.
Right. But according to the maritime data we're reviewing here, that is fundamentally incorrect. Iran hasn't actually closed the straits. The physical waterway is completely open. These massive commercial ships have simply chosen to stop moving.
Okay, let's unpack this. Because the idea that global commerce just voluntarily threw on the parking brake is fascinating. If the physical waterway is open and there isn't a literal wall of warships blocking the path, what actually emptied the ocean?
It comes down to something incredibly mundane, yet, infinitely more powerful than a naval blockade. Insurance.
Sure.
Specifically, war risk insurance. When commercial vessels sail into a designated high-risk area, their standard maritime insurance policies just aren't sufficient anymore. They are required by their underwriters to secure additional protection. And to understand why the ships stop dead in their tracks, you really have to look at the math dictating those premiums.
Then the math shifted dramatically over a single weekend. Previously, ships sailing through this region were paying a war risk premium of anywhere from 0.15% to 0.25% of the total hull value of the ship.
Right, a fraction of a percent.
It's just a fraction. But then a group in London known as the Joint War Committee held a meeting. And as of that following Monday, that rate skyrocketed up to 1 to 3% of the ship's entire value. For a vessel worth over $100 million, that is an astronomical immediate leap in operating costs.
It changes the entire financial viability of the voyage.
How does a single committee meeting in London have the power to just paralyze global trade in the Middle East?
Well, the Joint War Committee is essentially a collective of the most powerful marine insurers in the world. They evaluate global threats and set the baseline for risk. And what happened at that meeting was a really harsh realization about the economics of fear.
The insurers looked at the escalating situation and got spooked.
They realized there simply wasn't enough money in the global insurance pool to pay out if a catastrophic number of attacks suddenly occurred in the strait. The risk became entirely unquantifiable.
Meaning they couldn't confidently predict how many ships might sink, so they couldn't price the policy accurately.
Precisely. And when risk becomes unquantifiable, the reinsurers—
The companies that insure the insurers.
Right, those massive financial institutions that backstop the insurance companies against catastrophic losses, they start pulling back. They sent out notices canceling their backing. And here's the vital piece of the puzzle regarding the maritime industry. In many respects, the ship owners themselves operate within syndicates where they are effectively self-insuring.
So holding the bag.
Exactly. They looked at the board, saw the reinsurers fleeing, saw the premiums jump up to 3%, and realized that sailing through those waters under those conditions practically guaranteed massive financial losses. Or worse, total financial ruin if a ship was lost without backing.
They made the only logical business choice available.
They locked their ships in place at various anchorages rather than bleed money.
They dropped anchor and just waited. But insurers don't raise rates to historic levels without a catalyst. The spike in premiums is a direct response to a severe escalation in actual physical maritime violence.
Yeah, the kinetic reality of what's happening on the water.
The update details a very recent attack on a Bahamian flag tanker called the Senegal Namib. This is a 19-year-old, 158,000-ton vessel. We're talking about a ship near the maximum size that can physically fit through the Suez Canal. It was sitting entirely empty, riding high up out of the water in a large anchorage off the coast of Kuwait.
And the method of attack wasn't a traditional anti-ship missile fired from a fighter jet or a coastal battery.
No, it was an unmanned surface vessel, a USV. A remote-controlled Iranian drone boat packed with explosives that literally steered itself directly into the port side of this massive stationary tanker.
Just drove right into it.
Because the tanker was empty and sitting high in the water, the explosion punched a massive hole straight through the steel hull. The visual comparison made in the briefing was to a Wile E. Coyote cartoon. Just a giant, sudden catastrophic hole blasted into the side of the ship.
What's fascinating here is that the strike on the Senegal Namib is part of a rapidly expanding web of maritime violence. It is not an isolated event. The Joint Maritime Information Center, which provides critical threat assessments to the global shipping industry, has been tracking a concerning series of recent casualties. They logged incidents involving two other vessels, the Gold Oak and the Libra Trader. Both of those were hit by unknown projectiles while transiting the Gulf of Oman.
Those ships sustained minor damage, but the situation with another vessel, the Safine Prestige, paints a much more alarming picture.
Yeah, that one escalated quickly.
This was a smaller container ship transiting eastbound in the strait. It was hit by a projectile just above the waterline, but the strike ignited a massive fire in the engine room. The situation deteriorated so rapidly that the crew actually had to abandon ship.
Which is the absolute last resort.
They were eventually accounted for, but it really illustrates the immediate life or death stakes for the mariners navigating these waters right now.
And the tension isn't limited to uncrewed drones and commercial casualties. We're seeing a massive naval escalation happening concurrently, which fundamentally changes the risk calculation for everyone in the region.
You're talking about the warship.
Yes. There was a recent, highly controversial incident where United States forces sank a gray-painted Iranian naval warship that had sailed from Sri Lanka out into the Indian Ocean.
Sinking a sovereign naval vessel is a massive step beyond intercepting drones. How does an event like that reshape the rules of engagement in those waters?
It creates a massive diplomatic and military shockwave. To contextualize the gravity of this, we can look at a historical parallel, the Falklands War.
Right.
During that conflict, Great Britain established a strict maritime exclusion zone around the islands, stating any hostile ship entering it would be sunk. However, a British submarine torpedoed and sank the Argentine cruiser, the General Belgrano, while it was sailing outside that explicitly established zone.
Which created a huge crisis for the Thatcher government at the time. They had to justify sinking a ship that was technically outside the boundaries they themselves had drawn. Right now, both the United States and Iran are facing similarly complex diplomatic questions regarding this recent sinking. And as a reminder for you listening, we are strictly looking at the facts and historical comparisons presented in the geopolitical update here. The U.S. will have to navigate the international fallout of targeting a sovereign vessel in international waters, while Iran faces intense scrutiny over their decision to deploy a naval vessel into an area where the U.S. had explicitly declared it was actively targeting Iranian naval assets.
The geopolitical tension is at an absolute boiling point.
And that extreme tension, where sovereign navies are actively engaging each other, is precisely why the commercial shipping industry remains paralyzed. They are waiting for a viable framework to make the water safe again before they move billions of dollars of cargo.
Which brings us to the proposed solutions, or at least the attempts at finding one.
Yeah, the U.S. proposed a two-part solution, announced by the Trump administration via Truth Social. The plan outlined the U.S. government underwriting the insurance risk for these commercial vessels and providing physical naval escorts through the dangerous waters.
Right.
If the U.S. government steps in as the ultimate insurer, doesn't that solve the financial paralysis we talked about earlier?
In theory, yes. In practice, the maritime industry is highly skeptical for two distinct reasons. First is the sheer scale of the financial liability. Having a government assume the war risk for massive commercial fleets transiting a hot zone is a staggering assumption of global financial liability.
But basically a blank check for disaster.
Exactly. And second, and perhaps more critically, there is a profound lack of physical military assets available in the region to actually execute the escort portion of the proposal.
Let's break down those assets. The current U.S. naval presence in that specific region consists of roughly 8 Arleigh Burke-class destroyers and 3 littoral combat ships. Now, to a layperson, that sounds like a formidable amount of firepower. Why isn't that enough to escort the commercial traffic?
Because of the asymmetry of modern naval warfare, Arleigh Burke-class destroyers are multi-billion-dollar warships equipped with highly advanced radar and missile systems. They're primarily designed to protect aircraft carriers and intercept high-altitude, sophisticated threats.
Right, they're not built for what's happening in the Strait.
No, they are not optimally designed to play whack-a-mole with overwhelming swarms of cheap $2,000 remote-controlled surface and aerial drones. Furthermore, trying to physically escort over 100 slow-moving commercial ships a day through a narrow strait requires a massive volume of patrol vessels. 11 ships cannot physically cover that much water or protect that many civilian targets simultaneously.
We can contrast that with how the European Union has handled similar escort missions in the Red Sea. The logistics are incredibly demanding. To provide escorts in that region, the French had to deploy their nuclear aircraft carrier, the Charles de Gaulle, along with a complement of highly specialized air defense destroyers.
And even with that massive, concentrated projection of naval power, the French task force was only escorting 2 or 3 commercial vessels at a single time.
2 or 3 at a time.
Scaling that highly intensive escort model up to accommodate the 120 ships a day that normally pass through the Strait of Hormuz is logistically impossible with the current footprint of U.S. assets in the area.
Here's where it gets really interesting. Because while the navies and politicians attempt to figure out these impossible logistics, the global market is reacting in real time. We promised to explain how this impacts your wallet, and this is the mechanism.
Yes.
Because of the extreme risk and the resulting paralysis, the cost of shipping the few vessels that actually are moving has absolutely exploded. We're looking at data for a supertanker contracted to carry 2 million barrels of crude oil from the U.S. Gulf Coast to China. That single shipment just hit a record-breaking $29 million shipping cost.
And to put the velocity of that price hike into perspective, that $29 million price tag is more than double what it cost to charter that exact same journey just 2 weeks prior.
A 100% increase in 14 days.
It's wild.
And that $29 million doesn't just vanish into the ledgers of a shipping company. It is passed directly down the supply chain to the consumer. That new charter rate adds roughly $14.50 to the transportation cost of every single barrel of oil on that ship.
Right. That is a massive percentage increase applied to the raw material of the global economy.
Which inevitably cascades into the energy market, manufacturing costs, and directly to the price you pay at the gas pump. But if the major fleets are anchored and refusing to move, who is actually taking these $29 million contracts?
Well, the financial fallout isn't solely about rising costs for the consumer. It has also created unprecedented profit opportunities for a specific subset of operators willing to take the ultimate risk. When the major players pull back, boutique operators step into the void.
The update highlights how certain shipping companies, particularly independent Greek ship owners, are demanding and receiving what is described as Scrooge McDuck levels of money to brave the Persian Gulf right now.
Scrooge McDuck money, yeah.
They are securing specialized contracts that pay out tens of millions of dollars just for a quick, terrifying run into the Gulf, loading up at a terminal and rushing back out. When the potential payout reaches that magnitude, the calculation between crew safety and corporate profit starts to violently shift.
It certainly does. And the container shipping side of the industry reveals an entirely different set of market dynamics, requiring a bit of critical thinking to fully unpack. We are seeing a fascinating paradox regarding the massive container lines.
Oh, the overcapacity issue.
Yes. For the better part of a year, these companies have been signaling to the market that they are suffering from overcapacity. They built way too many ships during the pandemic boom, and they claimed this surplus was driving down their shipping rates and hurting their bottom line.
They were actively canceling scheduled voyages to artificially restrict the supply of cargo space. But now, with traffic halted in the Red Sea and the Strait of Hormuz, these same companies have completely reversed course.
Right.
They are suddenly refusing to scrap their older, obsolete vessels. They're utilizing the current geopolitical disruptions as a justification to keep their massive fleets fully operational.
They're leveraging the chaos to maintain inflated shipping rates and soak up massive profits, extending what analysts are calling their COVID cash cushion. This dynamic perfectly illustrates the vital difference between paper capacity and effective capacity in global logistics.
How do those two concepts differ when we look at the physical map?
Well, on paper, if you count every hole in the water, there are more than enough container ships to handle current global trade volumes. But when geopolitical disruptions effectively remove the quickest, most efficient routes from the map,
Like the Suez Canal or the Strait of Hormuz.
exactly, that capacity is suddenly absorbed by geography. Ships are forced to take massive, inefficient detours around the Cape of Good Hope at the southern tip of Africa. A voyage that should take weeks suddenly takes a month or more. That extra distance artificially eats up all those extra ships, turning paper overcapacity into an effective capacity shortage. For these operators, chaos is quite literally cash.
Chaos is cash. But the chaos is not contained. The paralysis in the Strait of Hormuz is just one focal point of a much broader contagion.
If we connect this to the bigger picture, we're witnessing a fundamental breakdown of maritime security on a global scale. The world's oceans are rapidly reverting to a Wild West environment where commercial vessels are considered viable targets.
The disruption spans multiple continents and entirely different conflicts. Concurrently with the Middle East crisis, there was a major strike in the Mediterranean, where Ukrainian forces successfully attacked and sank a Russian liquefied natural gas tanker, the Arctic Medegas.
Right.
And simultaneously up in the Black Sea, a drone violently struck a Liberian-flagged bulk carrier that was fully laden with Ukrainian corn bound for Spain.
We are seeing vital energy supplies, containerized consumer goods, and global food staples all being targeted in entirely different bodies of water at the exact same time. The scale of the disruption is unprecedented in modern maritime history.
So what does this all mean for you, the listener, trying to navigate this landscape? Right now, the global supply chain is trapped in a very tense, incredibly expensive waiting game. There are massive anchorages filled with empty ships waiting for the risk to drop and loaded ships waiting for an escort. But that waiting game has a breaking point.
It does. Analysts are anticipating a looming snap. There will be a moment when the reserves of oil and goods get so critically low and the financial bounties offered to move them get so extraordinarily high that the ship owners will just pull the trigger. The fleet will collectively decide to rush the strait, regardless of the insurance coverage or naval escorts.
But the update warns that this snap is not a solution. A return to movement does not mean a return to normal, does it?
Not at all. The resumption of traffic will likely be a double-edged sword, just as violently disruptive to the global supply chain as the current halt. Think about the physical logistics of the situation. You have an artificial dam holding back an ocean of delayed oil, liquefied natural gas, and millions of shipping containers.
When that dam breaks, all those delayed ships are going to hit their destination ports at the exact same time.
Exactly. It will cause a sudden, unmanageable flood of cargo. The receiving ports, the rail yards, and the trucking networks are not built to handle a massive, instantaneous spike in volume. It will overwhelm the global processing systems, creating massive cascading backlogs.
So the shockwaves keep going.
The shockwaves of this localized disruption will cause whiplash in the global logistics network for months, if not years, after the ships actually start moving again.
It is a sobering reality that the eventual resolution to this crisis will bring its own massive wave of chaos. But before we wrap up today, there is one final detail buried in the briefing that we really need to address because it changes how we view this entire interconnected system. Amidst all the data on exploding drone boats and diplomatic fallout, there was a brief mention of rampant GPS spoofing occurring throughout the region.
Yes, and this is a detail that deserves deep consideration from everyone listening. In an era of hyper-advanced technology, the captains of the world's most critical supply chains are currently being forced to navigate the globe's most dangerous waters, relying on their own human eyes, basic localized radar, and manual cross-checking with paper charts.
Like we're back in the 20th century.
They are doing this because the digital navigation systems that the entire world implicitly trusts are being actively, maliciously manipulated with false positional readings. It leaves us with a truly chilling thought to mull over.
Yeah.
If the very digital maps we rely on to move 20% of the world's oil can be so easily hacked, altered, and weaponized by localized conflicts, forcing massive supertankers to navigate blindly in the dark, just how fragile is the grand illusion of our secure, interconnected global economy?
That is a phenomenal question to leave off on. Thank you for joining us for this deep dive. We hope we've helped you bypass the noise today and get straight to the forces shaping our world. Keep questioning the map, and we'll see you next time.